We have the mortgage geek in the house here to follow up on the video Derrick made last week in regard to the bubble watch. Please welcome the president of Cornerstone Mortgage Group, Sean Cahan.
We have a lot of comments here that I do want to read and get to. Several of these are real estate agents in the area. We also have comments from a home buyer out there that I would like to address and get your opinion on. So You've been very honest with me in the past about this stuff. You've sold your own personal real estate portfolio here locally.
I have, yes.
So, I mean, what is your take, being one of the top mortgage lenders in San Diego? Things that you're seeing now, are you blown away by anything? Are you hearing anything from buyers? Do you still feel like you made the right move in selling your properties?
I definitely feel like I made the right move, because it always says like you can never sell too early, but you always can sell too late. I just got done reading the book Aftershock, and it also talks about kind of like, hey, you can always sell too early. And never, don't try to time the market right, because then you're going to be probably selling too late. So I get nervous about that kind of stuff. This book, Aftershock, is like, it's all about currency. It's all about bubbles and kind of like where the bubbles have been, in the timing of it. And one bubble affects another one. And it's like two identical of what actually economy has been going through and kind of where we are today.
Okay. So you still have some concerns then, based on where we are right now?
I definitely have some concerns. November and December were kind of following those concerns. Like I was like, wow, it's really coming to a head here. Things are slowing down tremendously. And then all of a sudden in January, it's like, boom, picked back up, and everyone's just kind of like, I want to buy again. The market's kind of come back down. The interest rates have kind of corrected itself. And I was like, whoa, what are we going into again?
Yeah.
As long as the U.S. is not going to be printing money, I'm okay with like riding out where it can go.
Okay.
As long as we don't print money.
Funny you mentioned that. Jeremy Katz commented on the video saying, in December we saw signs of a problem. Now in January, it's the opposite. Inventory is once again at an all-time low, and sellers aren't listing in the new year as fast as expected.
Correct.
And that is the big issue, right? It's all about inventory. The reason I made the video was because I was concerned that there were a lot of people who've been wanting to sell that have been putting it off because they're getting paid to wait. Okay, I heard a lot of people, I talk to home sellers every single day casting for when this listing, and I hear a lot of people saying, well, I feel like we're getting paid to wait, we may as well wait.
Yeah.
That's built up that's inventory potential right there. So those people all of a sudden go, oh, prices stop going up, now it's time to sell, and they all do it at once. That's what can kind of cave a market in.
Absolutely.
That's what my concern was. Jason Cassidy also commented, he's an agent here in San Diego. I think that it's extremely important to preface this type of video with a, please speak to a licensed professional for best advice. I would also say that in almost every single instance. In this case, it's one of those things where people have to make their own decisions about the reality of their life first, like what's important to your life. And the investment, I think, comes second. Jason says, overall, your macro points are correct. The market moves in cycles, and it's looking awfully like the end of a normal 7 to 8 year run-up. And we're almost certainly going to see a correction soon, but that doesn't mean immediately that you should sell your home. This talk should be very tailored to investors, rental property owners, et cetera, who are trying to time the market for maximum gain. And of course,
I like that.
A good point.
Yeah.
A good
Great point.
Daniel Lehman commented as well on 30-year fixed and in it for the long term, not super worried. Totally get it.
Here's what a 30-year fix does is like, at this time, like actually cashing out and bringing your mortgage up to its maximum potential to get your capital back out, right? And to get into a low 30-year fix, even if the interest rates are not in the 3s, if they're in the 4s and the 4.5, that's still really good. It's probably the number one best way to hedge against inflation, right? Because if the inflation continues to go up 2% or 4%, because we haven't seen any inflation in the last 5 years, it's going to have to start bringing back into the market.
We hope so.
Yeah. I mean, it's healthy.
Yeah, it's a good thing.
So if you're paying 4% today and say inflation goes up 1% every single year, are you really paying 4% in the next 4 to 5 years?
Right.
No, because so it's a really good way.
Okay.
So that's why it's really good to have it. But at the same time, we also want to be realistic too. And a lot of people aren't trying to list their homes because they have nowhere to go. There's not enough market. So it's just kind of like, it's a push sub type of deal. Like
chicken and the egg, man.
Yeah, like where are we? We need to have people start listing, then they need places to go. And then the rental markets, the rents gone up quite a bit. So
yeah, and that was in fact one of the things that we'll get to here. In fact, let's go to James Nooney's comment right now. Best live comment gets $25 Amazon gift card for those of you who are watching right now. James Nooney, who actually commented on the YouTube link for the video that I created last week, says, so what do you advise a first-time buyer like myself to do of the following two options? Option number one, buy a condo/townhome that might be overpriced, or option number two, pay almost the same as my mortgage in rent. This is a tough spot. Now, I asked James a couple more questions, and he has a 1 to 3 year time horizon. So he's wanting to buy a starter home, build some equity in a few years, and then buy, his forever home, which does work sometimes.
yeah,
But I think it's a riskier thing to do right now, especially in the condo space and the attached home space, because that's where we see, a lot of times when a market turns, that becomes a less desirable property type.
correct.
So I think for first-time buyers right now, definitely be very careful about what you're doing. Talk to some people who are smart. Talk to Sean, talk to a smart agent. Really, let them know, tell them what you're thinking. Tell them what's going on. Pick their brain. It's not like they're working against you or there's, some robot, on the phone who's, doing your loan or selling you a home. Talk to them, say, hey, listen, this is what we're trying to do. And you'll be amazed. Max, we've had on the show a number of times. Max Volkers, picking his brain and just going, Max, what would you do? What are you doing right now? Ask them, what are you doing? Are you buying property right now?
Yeah.
What are you doing? I think that's a smart move to make for someone like James, who's a first-time buyer, doesn't really know what's going on. He also said he was concerned that he's FHA approved, but is having a hard time finding complexes
that are FHA.
That are FHA approved.
Because it goes away after 2 years.
Is that how that works?
Yeah.
Why?
Unlike VA, where it's on there forever, unless it goes into litigation, then it'll be suspended just for a short period of time until the litigation is over. And then once you send over the litigation paperwork showing that it's been solved and the issues have been fixed, then they'll bring it back on there. FHA doesn't want FHA concentration. That's why they don't want more than 15% of the complex to be FHA, because they don't want to take that position on the complex.
And we did see, I think, day one, the Trump administration rolled back the cut in the FHA insurance premium, which
not smart.
That was another thing that made me concerned, because if they were willing to do that right away, what does the health of the FHA fund look like?
Well, it's actually healthier. That's why I'm saying it's not smart. It's actually healthier to bring the FHA. When FHA the mortgage insurance premium was like a 1.75, well, that's a factor of 0.5, they were actually healthier, because what they're doing right now is they're losing a lot of those loans to the conventional 5% down in these home-ready products, where FHA could actually attach themselves to that loan and be making a lot more profit. So when he did not decrease it back down, it kind of was like, whoa, wait a second. You're kind of looking at saying, hey, we're losing 20% over here of our mortgage insurance premium, but he's not looking at the other side saying, look how profitable we were, because look how many more loans are coming through FHA.
I see. So the FHA is going to miss out on those conventional borrowers, conventional qualified borrowers.
Correct.
Because the MI is too high.
Because the MI is too high. So on a 5% down conventional, the mortgage insurance rating, is 0.41%. So why would you go the conventional route with a 0.41, where the MI, will cancel itself after roughly 8 to 9 years, compared to an FHA where your mortgage insurance premium is 0.85% and it's on there for the entire life.
I wonder why they don't do credit qualified MI on those FHA deals, because that would also help them compete more with the conventional deals, right?
Yeah, but it's more about, you're not going to have a third party that's going to be underwriting the FHA. So the underwriter that's underwriting the FHA is automatically giving that mortgage insurance, instead of having a third party or a delegated MI, having another overview. So I think that's kind of what they wanted to go away from, my personal opinion. Just kind of make it a much simpler process. If you're approved for the loan, you automatically get the MI. Compared to back in 2010, 2011, remember the big bad brother of the MI was saying, yeah, DTI 45%, not with us, 41.
Mm-hmm.
Hey, we liked your product, not with us at the very end.
Right.
And then they started following agency, which was nice.
Well, I think that it's interesting that FHA is funding so many more deals now as a percentage. Their market share is up so much. Because subprime sort of went away, and there are still a lot of people who have less than perfect credit who want to buy homes.
Correct.
I think this could be a sign that they don't want so much paper flowing through FHA, because you've already got, 4/5 of every mortgage or 3/4 of every mortgage going through Fannie and Freddie, which is still attached to the government. Hopefully that won't be for long. And then you've got FHA. So like the government is funding all these deals.
Yeah, they really are. They're funding a lot of deals.
I mean, they're funding all these deals right now. And I think that's a scary proposition for them. And I think the Trump administration probably sees that, and that's my guess as to why they were doing that.
I mean, I said, whoa, wait a second here. Why did you do that?
Yeah.
You know, because FHA streamlines.
Yeah.
It's a great FHA streamline with the MI.
That's true. Well, we'll see what happens.
It is what it is.
Jason Lopez, also an agent here in San Diego, commented on the video, not a crash, a shift. We have 4 cycles: top of the market, downturn, bottom, and recovery. We have been at or near the top, so the next cycle will be the downturn. My company, has been planning for this for 6 months. When we enter a new cycle, that's when you are to start acting like it's already the next cycle. So he's saying once you enter the new cycle, prepare for the next cycle.
Oh, okay.
And I think that does make a lot of sense. We've definitely been at what I would call the top of the market since we've had a really low inventory circumstance. A lot of areas of San Diego, we have a 1-month inventory.
Yeah, it's too low.
Which is crazy.
It just drives up prices because no one can get in.
And to my point, so the original video, which we're following up on today,
Okay.
my point was that it's still a good time to be a seller. I just don't know how long that will last.
Correct.
You still have the advantage, a huge advantage to sell in this market versus buy. But I just don't know how much longer that can last. And I think every day that goes by, the risk increases. And I think you're too close to the edge of the cliff. You know what I mean?
They call it the market cliff and aftershock.
Yeah. Really?
Yeah.
So-
Literally, they call it the market cliff.
I think you're getting too close to the cliff.
Yeah.
Everyone's got a blindfold on. We don't know where the edge is. But if you know you're getting close, I think it's time to turn around. I don't think we need to try to go all the way to the edge and turn. And that's what people are trying to do when they time the market, trying to sell their homes. So
I always say don't try to time the market. Like I was talking to a first-time home buyer the other day and last week, and they're like, "Is right now is like a good time? Am I timing the market correctly?" And I was like, "Don't try to time the market because you'll always miss it."
Yep, it's almost
Can
impossible.
you afford the payment? Do you feel good about your home purchase? Doesn't matter what the interest rates is, right? Doesn't matter, because if interest rate's 4.5, it yields that payment. So if you're good with that payment, if you can afford that payment on a long-term basis, you're not looking to like make a quick dollar, you're not improving the property to try to sell it, then if it's a long-term play, then don't look at the market, look at your actual statistics of what you're actually working with right then, the purchase price, your down payment, and what the payment's going to be. And if that's something you can afford and it's good, then buy it.
If you have a 10-year window, you have nothing to worry about.
Then do it.
That's one of the things that we can say looking back at the data. You have a 10-year time horizon, you do not need to worry about the market. Worry about your own individual situation, whether that's satisfactory to you or not, whether you can afford the home that you're buying. And if interest rates, let's say interest rates are higher than you thought they were. Let's say you thought they were 3% and you qualify for 4%. Well, guess what? If rates go down, you can easily capitalize on that.
Correct.
So, getting in, but if you're comfortable with the situation as it is and rates go up, you'll be happy you got it, won't you? So it's like, that's the thing, you always win when you're a borrower, because like, if you get in and rates go up, then good job.
Yeah.
If you get in and rates go lower, then you refinance.
Yeah.
So you don't really need to worry about interest rates as much as people do. But great stuff. Sean Cahan, the Mortgage Geek from Cornerstone Mortgage Group. Thank you for coming in today, man. Really appreciate you joining us live here on the Win This Listing Facebook page. And of course, this is going on TV too, right? So we need to close this out. Stick around for more Smarter San Diego TV, where we guarantee to make you smarter than everyone else, commercial free.